All right, recording's going. This is week 3, I believe, of the new rags to riches cycle. Today, I want to talk about what I look for when I'm looking for the investment side. So we've talked about what the market is, how everything works, the volume, brokers, all that good stuff. Now we're going to talk about what I look for specifically when I'm buying my investments. Because remember, let me just grab my snippet tool here. When I am looking for a position, it is just a place to store money. I'm just putting money into this engine, okay? So I've got these two stages out of the way already, okay? Now I've got that, and I've got that on a smaller size. And what these boxes represent is going to be financial stability outside the market, okay? Oh, let me share my screen as well. Sorry about that, guys. All right, can you see it now? I see you guys. I see you mentioned it in the chat after I caught it. Glad we're all on the same page. All right, so I've got these 4 blocks here. These just represent what we've talked about already so far. Financial security outside the market to the point where I can make consistent contributions comfortably. I don't want to be eating ramen just to grow a portfolio because that kind of defeats the purpose. And it doesn't really get you any better results, okay? And then out of those contributions, I put 70% into investments, and I put 30% into speculation. Okay, and then that way, if I mess up horribly on the speculation, it's okay. I get tax credits out of that, and I don't have to worry about it destroying my portfolio because the 70% will carry the growth of the portfolio trajectory. As long as I don't move money out of the investment side into speculation and lose it, I'm storing at least 70% each month of those contributions over and over and over again. Does that make sense to everybody? So just that act alone, and then just not dumping it into high risk stuff and losing it without the ability to make it back, will naturally grow a portfolio. Okay? And then within the investment side, we've got slots, basically, or little buckets that we put our allocations into. So I personally choose 7, just because I do 70%. 1, 2, 3, 4, 5, 6, 7. Okay. No, that's 6. I'm having a day. All right. And then in this case, I'm using Pfizer. It would be Pfizer or Johnson & Johnson or something a little bit larger and a little bit private for growth potential. And then I'm going to offset that with something that's high yield, like Tesla. So in this case, I've done exactly that. I bought Pfizer and I bought Tesla. The reason for that is because Pfizer is going to be a longer term growth position, which will also provide me with income. Okay? And income. I really wish I could just type on this and then just kind of size it. So this means net positive, which means tax burden, okay? Then I've got a yield max ETF, which we don't buy just for the income, and we don't buy it just because we want to make a ton of money, and I'll explain why that doesn't work here in a second. And we want to use this to sell the shares for a loss. Tax advantage, right? And if you're not in the U.S., you might have different rules, but typically there is still some tax on U.S. companies and U.S. ETFs. So be sure to check with your locally licensed tax professional. So anyway, the name of the game is that these two play off each other so that I don't have to sell my Pfizer shares. I'd rather sell the Tesla shares at the end of the year or into the end of the year so that I can offset the capital gains tax from the income and ETFs in the event that I either do sell Pfizer or just the dividend payments that do just come in. Does that make sense to everybody so far? And then I want to do this, I want to structure the rest of this portfolio too with some broad market exposure. And then I also want to have, I'll just do broad mark. And then I also want to have some sort of income, right? So we've got growth and income in those other 7 positions as well, right? So there's a good balance there. Growth and income. Now, all the income gets reinvested into growth. It does not go the other way around. I'm not taking my dividends from Pfizer and putting them into Tesla. I want to make sure that the flow of money goes from one level to the next, to the next, to the next. Tammy, that's a great question. She says, curious, do you reinvest your yield max dividends back into them or into other stocks? They will always go into other stocks. I'm not going to use Tesla funds to buy Tesla, and I'll explain why right now. So when you buy a dividend stock, okay, let me just use a box here. Okay, when you buy a share of a company that offers a dividend, you're buying two components, just like a portfolio, right? Portfolio has two components. It's got cash, and then it's got things like shares and bonds and options and warrants. It's non-cash, right? So think of that as this component, and think of this as the actual share. Does that make sense? So you're buying little mini portfolios at the end of the day. They just don't behave like that. Beyond that, like we're going to limit that concept. But that's essentially what's happening. And then what happens is when you buy a dividend stock and you hold it through the ex-dividend date, when you buy it here, it's called cum div or with dividend. And then that separates on the ex-div date. That's what ex-div, it removes the dividend. So the cash portion of it gets converted into a cash payment at a later date. And then the dividend portion, the share portion stays the same, but it's at an adjusted rate because you've taken this price range or this value range and you've split it down into a smaller amount because this gets converted into cash. So it's no longer part of the open position. It's a product of the open position. Does that make sense? So that gets turned into cash, which is how you started, right? And then this gets converted into a share. It has as an adjusted value. Yield max should, in my opinion, should only be used for taking losses on the shares. So the idea here, right, given this understanding of how this works, we want to take the cash payments and aggressively reinvest them into investments, right? Because these are capital gains. This is a taxable event, right? Taxable event means you have a tax burden. These shares will get lower and lower and lower because they're not going to be able to offset. They can't recover from those aggressive dividend payouts and those adjustments. So the value of those will naturally decrease over time. They use synthetic covered calls, meaning that they're not going to make money unless the underlying is absolutely blasting, right? So this is why we want to use a smaller yield max position against larger investment positions, because I only need to sell enough of these to offset the taxes on very small dividend payments relative on these. So I don't need a big chunk of Tesla. I'm buying it early so I can get a little bit more aggressive income early on, but that's the idea. Is you also have the tax burden from the yield max ETFs themselves. So let's say, I don't know what the numbers are off the top of my head. Let's say that there's a $10 yield max ETF or some random ETF that's high income, high risk, right? Let's say they offer a 20-cent dividend, right? 0 to 0. Now, if they can't recover from $9.80 back up to $10 by the next payout, the share will lose value. So if they only recover, 10 cents, for example, 10 cents, then that means that this share is now worth $9.90 because it couldn't outperform the adjustment. Okay, so the share here will lose 10 cents. You will then have a capital gains taxable event of 10 cents, and there's a relationship there that you just have to be mindful of, because you're going to have multiple income events and you're going to have multiple adjustments on the shares. So we want to keep a ratio between the shares and their dividends, because remember, you get to claim in most cases the tax. I'm trying to explain it without making it too complicated. Just understand that your losses count for more at tax time in most cases. So just the main takeaway here is that we just don't want to load up heavily on yield max or any yield trap, really. Instead, we can use them strategically to offset the capital gains tax, while also taking these consistent high income payouts and reinvesting them into things that do have value and want to be held longer. So we're only using this to amass more of the stable stuff and then reduce the tax burden as we do that. Okay, so we're just pushing money in to both sides, the investment side and the yield max side, and then we're using the yield max as a tax neutralizer, as we can use the income from both to reinvest and grow the investment shares that we want to keep long term. Does that make sense? And it also keeps me from having to sell the long term position that I want to hold for a very long time. All right, so that's what we've talked about so far. Now I want to talk about how I pick the investment side, because that's much more important. You can take losses on anything. You can blast SPX at the end of the year, right? If you want to just bring down your capital gains. But again, that's not, it's too jarring to do that, especially if you have a good year. You don't want to watch all your profits go away. So this is much more manageable. It's much easier to control. And when we're looking for a company, we want to look for three things. 1, 2, 3. All I heard is blast SPX. What strike? Whatever strike your heart desires. It's not going to matter. They're all going to end up the same. So when I look for dividend stocks specifically, and you can replace dividends with passive options, it's the same process. You just want to be able to put your money somewhere that is going to yield you income that you don't have to work hard for, right? You're not going to be looking at these charts every day. You're not going to be caring about the averages as much. You just care about where you're going to let the money flow from one stage to the next. So I want to make sure the company's making money. First off, that is kind of what makes dividends go round. Money. That's not an M. All right, making money. That's criteria number 1. They have to be making money. Then I want to make sure that they're able to keep the money. Keeping money. If they're giving it all to their creditors, they're going to have a hard time. Money. God, I can't write. And then I want to make sure that they're willing to share the money with the investors. And this is typically what we see with dividend companies. Yeah, I always do that with my M's when I'm drawing with a mouse. I don't know why. I do know why. Never mind. So this is the trifecta of a good dividend position. I want to make sure that these are met, but I also want to make sure there's a couple other elements here. I want to make sure that they have a good history. Okay? If a company struggles financially and the first thing they go for is their dividends, I don't want to be in there because I'm not going to know about their financial trouble until they do, and that dividend's going to get adjusted beforehand, right? So I want to look for the dividend history in terms of consistency, meaning they haven't had to disrupt it, but I also don't want to see a flat dividend payout, right? Because if their shares are increasing in value because they're making money and they're keeping it and sharing it with investors, I want to see growth on their dividend trajectory. Does that make sense so far? Does anyone have any questions up to this point? Because I want to make sure we all have a rock solid understanding of why I'm doing what I'm doing. I hope so. I see Charlie writing, so I don't want to jump ahead. Good so far? Okay. Matster, yes, you have a question, or yes, you understand it? Okay, cool. All right, you understand. All right, good stuff. So we're going to hang on to this, right? I'll put this in the chat because this is going to be our roadmap. This is our checklist of things that we want to look for when we're looking at companies. So let me just type these out really fast. Making money, keeping money, and then sharing money, right? And then I want to see history, consistency, and then growth. Okay? So these are the golden criteria here. If I pull up stock analysis, I forgot I had my caps lock still on. All right, so here's stock analysis. This is just a site where you can look at financials relatively easily. So if I'm looking at, let's say, for example, it's a Realty Income Corporation. I don't care about the technicals. I don't care about the shares necessarily. I just want to see that they have a good financial base and that they're willing to give me exposure to that. Like, that's my goal. Now, I know personally that O is a long-term good dividend stock. O and Main are very, very solid long-term. They're very popular picks for portfolios, and they're in an affordable range, right? So if I'm putting in $500 a month and I'm putting 70% of that, which is $350, into investments, I know that I can't put $50 into this. I have to do a little bit more if it's more than $50. So the original $50 can just sit in a bucket somewhere. Maybe I grab one share. Maybe I overallocate a little bit. But the idea here is that I'm not going to put 300 of the 350 into this one stock because I want to have that structure in place where I've got dedicated allocation amounts for each position that I have. So first criteria here, are they making money? Let's look at that. So I pulled up I go to stockanalysis.com, I type in the ticker, I hit the button, and I click on financials. Okay, and I'll zoom in a little bit so you guys can see that. Then the first thing you're going to see here is the income statement. There's the income statement, balance sheet, and the cash flow. I don't care about ratios or KPIs. They're just summaries of things that we can already see. Yeah, Charlie, this is recorded. Let me make sure that that's going as well, and that I'm not muted. Okay. Yeah, we're recorded. We're good. So what can I look at to make sure that they're making money? So the first thing I'm going to see is revenue. Revenue is what they get paid by outside people. Okay. It's not how good they are at handling their money. It's just how much money they're able to make from outside sources. Okay. So I want to see this grow. I want to see this number going up. Right here it does. It's a great example. I love this. It's a nice, clean scaling up chart there. A lot of this other stuff is either sub-items like revenue growth year over year. That's just a summary of a trajectory there. It's like a moving average. I don't care about that. I don't care about most of these. Gross profit, I don't really care about either. It's great that it's increasing, but it's not a deal breaker. Depreciation and amortization expenses, we only really look at a lot of these if there's a red flag somewhere else. So if I see a company that has high debt, I want to look at how their debt is structured so I can see if it's healthy or unhealthy, right? So I don't really care about anything other than revenue for now. Operating income, that's going to vary by company and by sector. For this, I don't care about it. Charlie, you got a hot mic, by the way, just so nothing personal pops up.
Okay, guys.
No, you're good. And then I don't really care about shares outstanding or EPS or any of that stuff. I mean, that's good if you're looking for the growth and the income side, but I'm only really looking for that dividend growth for this, right? The one thing that I do care about above all else is the free cash flow. So if, for example, you owned a hot dog truck and you're selling hot dogs to people, it would cost money to run that. You'd have to pay for the truck itself. You'd have to pay for insurance. You'd have to pay for food permits, hot dogs, the buns, the sodas, the ice, the fuel for the stove, any kind of insurance, blah, 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 right? There's expenses. And then when you sell the hot dogs and sodas and things, you get revenue. You get money from customers, right? And then maybe if you have sponsors for maybe local companies want to sponsor you and you park your truck outside of a baseball little league thing, right? That's also a form of revenue. Now the free cash flow is the difference between those two numbers. So it's just the number of dollars that hot dog vendor gets to go home with in their pocket at the end of the night. Does that make sense to everybody? It's the cash they keep. Which brings me to criteria number 2. Are they keeping money? Right? So we can look at revenue, free cash flow, and then I got to look at, are they sharing money? Right? So far, if that makes sense, slap a 1 in the chat just so I know, because I don't want to go too fast, but I also don't want to go too slow and focus too much on the stuff you guys already get. So if you have any questions, blurt them out. I don't really care about anything else here for this one. EBITDA is only really useful for certain sectors. It's just one of those things it's not really relevant for this. And that's earnings before income taxes, depreciation, and amortization. That's more for like evaluating a company, specifically like financial companies. So I don't have to worry about that right now. So for the income statement, I only really care about revenue and free cash flow, which makes all this very simple, right? Charlie says free cash flow is take home of income, profit on hot dog sales after expenses. Yeah, taxes also, taxes and expenses. Yeah, what's up, Duco? Next thing I'm going to do is go to the balance sheet. And again, if I see a red flag on the income statement, then I immediately come to the balance sheet anyway, because I want to know what's going on. I don't see any red flags here, so let's look at the balance sheet. What do I need to look at? Cash and equivalents. How much cash do they have on hand to do things? How much is in their bank account? If they have to make decisions, how flexible can they be? So in this case, I would like to see a positive number. If I see a red number, that's kind of a red flag. But there might be an explanation for it as well. So, free cash flow and then cash and equivalents, right? And then since we could very easily just go over to FinViz here, but what I like to do is look at the total current assets and the total current liabilities and make sure it's greater than 1-to-1. So in this case, we've got a total current assets of 1,631. These are millions, I believe, or 1,000. Yeah, millions. Okay. So 1.6 billion in total current assets, and then I've got 3.5 billion in total current liabilities. And what this number represents, is total current assets are the number of dollars that they could generate if they sold everything today. It's the amount of short-term liquidatable assets that they could generate if needed, okay, plus cash on hand. Total current liabilities is their 1 year scheduled debt. So that's things like mortgages, leases, payroll, insurance policies, any obligations they have that are scheduled and to be paid within a year goes under total current liabilities. So I want to see more cash generating power than scheduled expenses, because I want to make sure that if they ceased operations today, they could continue to survive for more than a year. Okay, so if we divide this number into this one and we get less than 1, which we'll get like a 0.5, that tells me that this has a less than 1 current ratio. So if I go over to FinViz, I can confirm that. I'll just type in O here. And again, I'm not so much concerned with that specifically because I only really care about how their dividends perform. But you can see here on the current ratio on here, it says 1.86. So there's a discrepancy there. So I'd want to look at the actual earnings report and see what's going on there. So that is odd. Now, historically, these two numbers have been in this relationship where the liabilities are larger than the assets in the total current. So TCL, TCA. Not the total assets. That's different. Does that make sense to everybody? So there's a discrepancy here, but again, it's kind of an outlier company. But I don't really care so much about this. This is more for like swing trades and things like that, longer, like medium-term investments, I guess. Not so much for dividend income, right? And then, of course, you can compare the total assets, total liabilities. This should always be a positive number. If you ever have more total liabilities than total assets, I would just run for the hills screaming instead of trying to buy that for dividends, personally, right? And then I like to look at net cash debt. This is increasing in magnitude, so I don't really like to see that. But I'm sure there's a reason for it. Their total debt isn't as scary, but it is still a big red number. So now that I know the company has a lot of debt, I want to make sure that they're not going to impact my money, right, as an investor. I want to make sure that dividend priority stays at the top of their list. So, what I can look for, I don't really care about net income or DNA and all that. That's all the same stuff. Operating cash flow is kind of important, but we already have a lot of this information by just looking at the metrics we've already looked at. Investing cash flow, that's going to vary from company to company. It doesn't really matter here. But this tells us where most of their debt is. So it looks like they have some short-term debt that they recently issued. And they have kind of a history of doing that. Which doesn't necessarily mean it's unhealthy. They could just be establishing new lines of credit to expand what they have available in their codependencies with other entities, specifically banks. So these could all just be healthy lines of credit. We don't really know, right? We'd have to look. And then financing cash flow, that's a little inconsistent, but overall it's positive. So I like to see that. That's pretty good. Net cash flow, again, we already have this information. We've got the free cash flow. Now it's going to be a little bit different here than it is on the income statement. And that's just because this is an adjusted free cash flow as opposed to this one, but they're both kind of showing the same thing. And then again, we don't care about dividends or KPIs. So if we're not trying to swing trade this and get share appreciation, we don't really have to care about anything other than the free cash flow and the cash and equivalents, in my opinion, because that tells us the company is making this much after everything else, and they're keeping this much of it on hand. So the difference should be available to shareholders, right? So then we can come over to the dividends, and we can just take a look at these really quick. 5.24% dividend yield, that's just how much they pay over the course of a year. So it's an annual yield, meaning that the stock is currently $62, and at 5%, that would yield you an annual $3.25. So you're going to break that up into the frequency, which is monthly. So you divide this by 12. So 3.25 divided by 12. So you're going to get 27 cents per month as long as things don't change too much, right? So $62. I get 1/12 of 5.24% every month as I continue to hold these shares. Now, it doesn't seem spectacular, and it's not, but it is very consistent. It's 12 payments per year, and if we're buying these in bulk, that adds up very quickly for reinvestment purposes. Okay, we don't want a huge number because then that's huge taxes. I don't like a lot of volatility there, but I do like consistency, and that's what I care about. So dividend growth is positive as well. Again, that's not really because we're going to look at a better measure of that. Shareholder yield 7.62%, buyback yields 4.65 negative. This is the most important one. The growth years is 22 years in a row where they've increased their dividend. That is what I care about more than anything else, because that shows that they're prioritizing their dividend payout and they're prioritizing investors. Okay, so a good yield is above 2 or 3% per year. 22 years in a row they've grown it. You can see we calculated this 27 cents right off the bat. Very easy to do. We just divide it by the frequency. And you can see as we go back in time, the dividend amounts are incrementally smaller. And as we go forward in time, obviously they get bigger. This is what I want to see. I want to see increased dividend payments all along the way, as much as possible. Because again, this shows that the company is scaling up and they're systematically increasing their dividend as a proportion, right? Now, there's accelerations within that growth as well. You can see these little spikes right here. That's what you're seeing here. This is, think of this like the MACD. It's an acceleration metric, but these are all positive. I don't see a negative number here, which is good because that means that this all has positive slope. So if I'm an investor, this tells me they are sharing money. Dividend growth, right? So we found the free cash flow. We know that that's how much they take home after they pay all their expenses. We know that they have this much cash and cash equivalents on hand. We know that there are some debt factors that we should look at. And we know that they've got a 22-year history at 12 times a year, so 22 times 12, of increasing dividend payouts. Okay, that is a huge, huge pro, in my opinion, when it comes to finding a dividend stock. Okay. Now there's also, let's look at Maine, right? Let's look at the same metrics here. Again, I don't really care about this overview stuff. I'm not looking to speculate the shares. I'm just looking to buy and hold and collect the money. So first thing we do is click financials. We come to the income statement. Look at that revenue. It's positive. I like it. It's not really growing aggressively, but it's good enough. It's increased. Overall, it's good. Then we come down here to the free cash flow. It's spotty, right? I'm not a big fan of that. That's okay. Let's see how they handle it when it comes to the dividend side of things. Then I come over here to the balance sheet. And I say, all right, balance sheet, what do you got for cash and equivalents? Positive, which is good, but it's kind of declining. They had a little peak here in 2024. Again, not really a red flag, but not something I'm super happy about either. Total assets, total liabilities, we got a 2-to-1 ratio there. That's good. There is no total current ratio on this because there is it's a different type. It's a different type of structure. And sometimes you're going to see that. You can see here that their total debt is net cash debt. It's the same number every single time. And that's because of the structure of this ticker. Sometimes it'll be different. Sometimes it'll be the same. So we could just skip over all that stuff. Oop, we come right over here to cash flow. We don't really care about DNA or net income. We can look at it. That's good. But that's going to match the revenue because there's no other factor there. So it's going to be just the same. Operating cash flow negative. Not a huge fan of that. It's a little spotty, but it's expected, especially if the company kind of has inconsistent numbers there. Financing cash flow, that's mostly positive. That's okay. Again, not a deal breaker. And free cash flow we already looked at on the other chart. So not a deal breaker, but again, I know exactly where the friction exists. I know where the potential red flags are, right? So let's come over to dividends. I can see it's got an 8.73% dividend yield. This might explain things. If they're paying too much in dividends and they can't recover between dividend payments, they're going to have a negative. They're going to have to offset that somewhere else if they want to prioritize shareholders. They're going to have to take on debt. They're going to have to sell stuff. And that's okay. So this tells me every year they pay a total of $4.32, which means I divide that number by 12, and that is my monthly payment of 26 cents per share. Now this one is $10 cheaper, $13 cheaper than O with the same payout more or less. So you get a slightly more efficient payment per share. Does that make sense? Like if we scaled that up to $62 or whatever, $63, you'd get about 20% more. So another 4 cents. This would be about 30 cents. Okay. 84% payout ratio. And if you ever have questions about like what these numbers are on the other tabs anyway, you can usually put your mouse over it and just leave it there and it'll kind of explain it for you. Or you could just ask me, what's up, E. Michelle? You got a hot mic, by the way.
Sorry about that.
No, you're good. Just want to make sure nothing personal gets on the stream. So in this case, we get a negative buyback yield again. We get a positive shareholder yield, not spectacular. Negative 4.32% dividend growth. This tells me that they may be struggling, or they may have struggled historically, to prioritize shareholders. Okay, so this one's a little bit less quality than O, but it's still pretty decent. 5 years of dividend growth at monthly payouts. That is 60 payments of overall growth. So let's take a look. We can see that we got a 30-cent payout here in December 2025. And that's on both sides, that's 26 and 25.5 cents. So something cool happened in December, right? So they were trying to make it up. And they did the same thing in September, same thing in June. Now these are dual month payments. So I'm assuming these are extra dividend payouts because they paid on the 6th and then 14 days later they paid again. And then here in September, they did the same thing. They paid on the 8th and then they paid 30 cents again. So these are like supplementary dividend payouts. Okay. And this is a pretty frequent thing for these guys, which, you know, it helps it benefits the investors, and it also helps them on their books. So you can see they kind of got this little sawtooth action because of that. Like you can see that they're the little 30-cent spikes. So that's okay. I would accept that. I would say if we smooth this out, we get a pretty decent set of payouts there. We got spikes in growth, obviously, as a result of that. But overall, the growth is kind of declining. So that's a little bit of a risk factor long term. And I'm talking 10 years, right? I'm not talking next year. And then the dividend yield is kind of inconsistent as well, but it's generally hovering around 0, which is fine. You know, it's stable. So in this case, this is why I'm buying Maine as well. And then, so I have Pfizer, I have Maine, I have O, I've got Tesla, I've got, let's pull up Pfizer here. Okay, Pfizer's a $23 stock, or $26 basically. This one, I don't really care about the technicals. Again, I don't really care that, you know, it's very low volatility compared to the overall market. I don't care about the shares as much. I care about getting as many as I can. So revenue positive, not really boosting, but it's relatively flat, which is okay, as long as they make good use of it, right? Gross profit, positive as well. I don't really care about DNA or any of that stuff again. I'm just going to go right down here to free cash flow and say, okay, is it positive or negative? It's $9.5 billion positive. They had huge years in 21, 22. Of course, that's going to skew these. So 2 years from now, 2 years from now, this will be up here, right? Because it's going to scale up. So these look small, but these are like $9.5–10 billion in free cash flow, which is extra money. Remember, it's after they pay everything else. This is what they have left. So big dollar amounts there. And then for this, you know, you can grab it. Where is it? Where my brain's not grabbing it. Oh, it's on the, okay, my bad. I'm thinking of I thought we were on the other sheet there. Dividends per share is pretty decent. That's nice and high. It's positive. It means that they like their investors. Again, there are some red flags, but they're not huge ones. They're just little pieces of red tape, I guess. Again, for this, EBITDA doesn't really matter as well. Let's kick it over to the balance sheet. Cash and equivalents. What do we got? We got positive. They are keeping money. They have cash on hand. That's good stuff. Cash growth is a little bit inconsistent, though. It's a little positive here, a little negative there. Don't really like that, but they're able to keep that padding up, and they're getting plenty of revenue. So again, as long as they use the revenue intelligently, they should be fine. Total current assets, 42.822. These are in millions, so 42 billion in total current assets. 34 billion in total current liabilities. So a negative ratio there. It's less, or I'm sorry, that's a positive. It's a 1.25 or 1.3 current ratio, which is good. It's above 1. I misspoke. And then for total assets, I got 207.6 billion compared to about half of that in the form of total liabilities. So very strong financially. And it looks like they got plenty of cash on hand. It looks like they're using it well enough. It just might be a difference of, you know, is the CEO getting more money or are shareholders getting more money? So in this case, we look at shareholders' equity, and we can say this is pretty high and consistent. And we saw the dividend item from the income statement. So I think we're okay. I think this is a pretty solid one here. We've got some inconsistent debt, and of course that's, you know, you could see 2021, 22, they had these big spikes in revenue. So it looks like they paid down quite a bit of their debt. And then this is kind of their baseline. So not the end of the world. They got plenty of money to cover it. You know, this is 64 billion. They could pay that off like right now if they wanted to. They've got so much They have $207.6 billion in assets. They can easily cover $60 billion if they have to. But again, it benefits companies to have established lines of credit, which show up as debt. Just like it benefits us as we get our larger portfolios and we leverage them for low interest collateralized debt obligations, like securities-backed lines of credit. All right, net income, solid. Again, 2021, 2022, those are going to scale. They're going to skew these numbers here, but 2024 and onward, they're doing pretty decent. They got $7.5 billion net income. DNA, again, I don't really care about this. It doesn't affect this stock. That's just a sub-metric. I don't really care too much about their debt to look into it. It's just a lot of it's just in other operating activities, and we don't know unless we look at the SEC filings, and I'm far too lazy for that. Operating cash flow is nice and positive, very strong. It's $12 billion. I like that. So they have a lot of resources. They have a lot of options as far as how they address their operations, which is solid. I like that. So now let's look at the dividends. What is their dividend yield? 6.63%. They pay quarterly. So every 3 months, you get about 1.5% of the share price per share, and that's $25. Okay. Annual dividends 1.72 per year, which means that we just get a 6.63% of that number, basically. Good payout ratio. Dividend growth is very low, but it's above 0, which is good. And it's a quarterly payout. They've been growing their dividends for 15 years. So these are good companies that we've looked at so far. I'll look at some bad ones as well. But you can see for a $26 stock, I can get a 43-cent dividend. Right? Remember, we had a $63 stock that was giving us 27 cents. So I like Pfizer. They have a lot of money. They're willing to share it with investors, and they're doing okay. Right? Dividend growth over time is solid. They're definitely taking care of their investors. I like this company. The growth just kind of flattened out because we just had they have to announce it before this site will render it, but it's probably going to be around here anyway. And then their dividend yield is just forming higher lows. Okay, so I like Pfizer. I like it a lot. I also like Johnson & Johnson for the same structure, but it is too expensive to trade on this account, so I'm just going to grab the other one first. I've already looked at financials just so you guys can see. This is a $234 stock. It pays $1.34 per share, so not quite as efficient as Pfizer. So Pfizer is more affordable, but it's a little bit more debt heavy. So far so good. It's got a good ratio and all that good stuff. They've been growing their dividend for 64 years. So that's why I like Johnson & Johnson better, just for the long-term stability. And you can see that's just a nice clean chart. Now let's look at some crap companies so you guys can see. Let's pull up Visa. I'll also or Verizon. I meant Verizon. Sorry, I don't really have a grudge against Visa. Let's look at Verizon. $48 stock. Let's look at their revenue. It's flat, but it's positive. It's a big number. It's $139 billion for a $48 stock. That's solid. I like that. That's good stuff. What's their free cash flow? They're making money? Are they able to keep it? Yes. Okay. So far so good. Let's come over to the balance sheet. What's their cash look like? Kind of weak for those big numbers. They're not really keeping a lot of it in cash. So that's kind of a red flag, right? But it's still positive, right? So it's not the end of the world. I'm just saying that they've got inconsistent cash growth. So their money flow is a little bit unstable, right? Total current assets, 44.723 billion, because these are thousands of millions. So total current assets, 44. Total current liability, 69. So they have a less than 1 current ratio, which means if they close their doors, they will not survive for a year. Does that make sense? Let me catch up on the chat as well. Used to be in server muted, yeah. Epic says, can't we get a spreadsheet that pulls this from Finviz to see if it would qualify? Absolutely. Yeah, you can use the Google Finance function. And you can pull those numbers in if you want. Epic says, when I tried to pick mine, I asked my GPT to use a gram approach. It gave me Pfizer, UPS, and Nike. Okay. Good to know I'm in the club then. Don't know if it was the right pick or not, but I'm comfortable with the name tickers. Yeah, I mean, it's enough to put them on a list and research them, right? Charlie, take care of yourself. I know you're not here, but if you're watching the recording, I hope you have a good weekend. If I don't see you later, go do your appointment stuff. And yeah, I'm not a big fan of UPS or Nike personally, but I do like Pfizer. So total assets is positive. Total liabilities is less, but still positive. So this tells me, if they're going to be positive either way, above 0. But assets are greater than the liabilities, by about 33%. Not great, not terrible. But the fact that their current liabilities and their current assets have that upside down relationship tells me that their money management is a little bit less efficient than I like. And that's likely going to be taken out on the shareholders. Okay. Total debt, very, very high. Remember, their free cash was about 9 or 10. This is 196. So a lot of debt. They're very debt heavy. Not always a bad thing, but seeing that with the disrupted money flow, I get a little nervous, right? Net income, 17.77 billion. Meh, it's positive. It's good. I just don't like this company. Investing cash flow, all negative. Don't see any positive there. Not a good idea. And then that's kind of it for that. So let's look at their dividends. 5.84% yield. It's a $48 stock. Quarterly payout. They've been growing it for 21 years. So this so far is on par with the other companies. It's just a little bit less efficient. I'm more worried about their financials and their business practices. I think that if they are no longer able to retain ownership of all the lines that everyone else uses, they're going to struggle a lot. Just like NVIDIA. If NVIDIA gets a good competitor come in and just sweep out all their business, they're toast because they don't have any competitive edge other than their positioning. So in this case, Verizon's got a good growth history, but they also have a financial disruption history in that when they face challenges, they don't handle them well, right? And the first place they're going to take that money from is going to be the investors. Okay, so I just personally don't like this. I can get the same dollar amount off of a cheaper stock anyway, and I don't like telecom right now. So it's a personal preference. It's not a bad stock. I just don't like it personally. I think there's better opportunities out there. So let me catch up on the chat here. Still can't get myself to own Pfizer. Yeah, if you don't agree with the company's impact, I don't encourage you to trade it at all. There's absolutely an ethical side. And if something is going to be stressful to you, or if you feel like it's unethical, you have every right just to not touch it. You short it. It's all the same. It just boils down to your personal beliefs and your personal preferences. Okay. Hope one day it changes from a small amount to your main portfolio and a way of trading. Yeah, I mean, and that's the idea, is if we're just making consistent contributions and we're not giving them back, the number should just grow naturally. So let's look at UPS, right? United Parcel Service, $100 stock. I'm just going to blast through a couple of these really quickly. Revenue, positive. Free cash flow, positive but declining. Ooh, what's going on there? I'm not going to look at all the inefficiency stuff, but that tells me there's an operations thing. Because if their revenue, think about it like this. If they're consistently making the same amount of money, generally speaking, this is within 10, 15% over the course of 5 years. So they're relatively making the same amount every year. But the amount that they get to keep is drastically lower. This is a third almost of what it was. There's something going on in their operations, which is taking that money out of their pocket, right? Just like if we as traders suddenly have to start paying commissions, right? That's going to decrease our net P&L. Our realized P&L will be different, but our net P&L a lot of that will just go to fees. So it's an inefficiency, right? Now, looking at the financials, what do they have in terms of cash? Decreasing but stable lately. That's okay. Total current assets, total current liabilities. That's close to a 1. It's like a 1.25 maybe, 1.2. Total assets is 71. That's positive. That's an over 1 ratio as well. I don't really care about anything else. I'm not really looking for super deep insight on these. Investing cash flow, negative. Yep, all negative. Operating cash flow, this is where we're seeing that, right? So they're getting less and less money to operate day to day because they just can't. There's something in there that is just tugging at them. Something is looks like capital expenditures is a pretty significant factor, right? If they're making 7 or 8 billion and they're spending 3.5 or 3.8, their net income is going to be lower, and that's why we're seeing that decline. So it looks like a lot of that's just their capex. And again, just hold your mouse over it if you're not sure. That's just things are costing them more and more and more. So that is not a sustainable trajectory if they don't fix that. So I would want to look at their SEC filings, look for 8Ks, and then just see where that money is going. Where are they spending most of their money? What's costing them so much? Is it the property? Is it the vendor resources? What's their situation? Is it fuel? Are they affected by shipping? And how does that really apply over the last 5 years, right? Because they've got a 5-year trajectory here. It's not a recent catalyst. So it's some sort of long-term agreement or some sort of obligation that they have. So, looking at dividends here, decent enough yield. It's a $100 stock. So every year you get $6.56. It's paid quarterly with a 16-year growth rate. Not terrible, right? Dividend growth is very small. I like to see this at least 1% personally, but it is what it is. So they've been pretty consistently paying, in the low 160s. There was a little 10-cent jump right here in November 2022 into February. So that's interesting. I would also look at that and see, did they do some sort of split? Was there some sort of dilution catalyst there, which was just reflected in a 10-cent jump in price? So, yeah, I don't really like this. It's just flat. And I see more and more expenses. I see the same revenue, which means that's going to outpace the income. I see flat dividends, which means that they're not in a position to just taper the dividends back down, but instead they have to start taking away from dividends to offset that difference. And I think unless they change something, these guys are probably going to struggle and it's going to suck. So this is one that I would look for a longer term short horizon, if anything. I would just look for that tipping point where they're spending more than they're making. And this is kind of why the UPS is in trouble, Does that make sense so far? So in this case, this would be a bad example. This would be something that we don't want to commit a large chunk of money to. Epic says, Pookie, if our monthly contribution is like $100, do we buy fractional shares or buy what we can and rotate per month? So in this case, it depends on you and what you want to do. Let's say, for example, let's use my example, right? O, for example, is about $62, $63. I'll just put 63. My contribution is $50 for each of the 7 positions I maintain, right? So $350 total. Divide that into 7 positions equally. I've got $50 to buy this stock with. So month 1, my allocation is $50. So I can't really buy a share. No, the first month I did, obviously, but I couldn't really buy additional shares, right? And if I was doing this completely by the book, I wouldn't have bought the first share. Month 2, allocation would be $100, right? At this point, I could buy 1 share for that slot, right? And then I would have $37 in cash. Month 3, the allocation, right? The allocation is very standardized, right? Because we're not basing that on the share price. So my total allocation would be $150, which means I could have total of 2 shares, assuming the price didn't go up, right? So if it's $63 a share, that's $126 minus $150. I would have $24 in cash. Does that make sense? Are you checking the math? Okay. It's just 100 minus 63. And then month 4, right? Your allocation is $200. So you would have a total of $200 dedicated to that particular company, right? Which means if we divide that by 63, we get a total of 3 shares, assuming the price didn't change, right? 3 times 63 is 189 minus 200. We have $11 remaining in cash. Now, because you own these shares, you would also get a dividend payout, right? And if we pull up O, we know it's about 27 cents, I think it was. 27 cents. So let's add that 27 cents in, right? For this, this is a monthly payer, so you're going to get 1 27-cent payout per share per month. Now, in this case, since we're in month 2, we're in month 3, we would have had the second share through the beginning, through the ex-div date. So we'd get 0.54. And then for here, we've got a total of 3 shares. 27.54 would be 81 cents. Now, again, these aren't spectacular amounts, but they do contribute over time. And as the contributions increase, you get more and more shares. Eventually, these dividend payouts will afford you new shares. So at some point in the future, and remember, you're doing a lot of positions and a lot of allocations, and then you've got the speculative funds being trimmed and put over here. into the investment side to speed things up, you know that if let's just say this price never moves, right? If I need to offset $63, I know that I need a total, of $63 divided by 0.27 cents. So I need at least 233 shares, or 234 shares, right? Because you got to round up to buy one share for free. Because at that point, the dividends pay for the share. Does that make sense? So my goal for this position is just to get it to 234 shares, and then it kind of takes off on its own. So how much is 234 shares worth? 234 times 60, and again, assuming this never changes, I would need to amass about $15,000. Equals, 234 plus shares equals free shares every month. And I do this for all 7 positions. And then again, I've got that speculative stuff to speed this up. I've got all kinds of other factors for reinvestment, and I'm managing my taxes so I don't have to pay a bunch at tax time as well. So that fattens up my refund a little bit, shove it into the portfolio. That's a nice cash injection every year. This process is a very, very manageable system at that point. And now I know that all these companies are likely to also increase in share price. So there's a trade-off there. I get growth and income. Because if the company's making money overall and they're sharing it and they're giving it back to investors and they're able to continue growing their dividend, that means that they're outperforming the adjustments from the dividend payouts, which means the share prices are naturally going up over time as well, because they're able to recover how much they pay to investors, which I can also break down, right? Because I understand how numbers work, and I can say, all right, well, what's the overview here? This company has, where's their float? Shares outstanding. We'll just use that. $935 million shares, right? And I know that if I've got a 27-cent dividend, right, 935,170,000 divided by 0.27, I just know that $3.4 billion needs to come into this stock in order for it to go up by enough to do the offset. It needs to be able to offset the income, right? So their revenue is increasing by twice that annually. So I think we're in a good position here. So that's the idea anyway, right? Now, we don't have to get super granular like that. I don't want to make it complicated, but I do want to just show that there is a system here. It's not just buying stuff and holding it and hoping things go up. There's a very deliberate system in place. And we're just using this first stage to move to the next stage. And we're using all these stages just to get to that last stage where we take our total account value and we can bring it to a specialized lender and take out something like a securities-backed line of credit. So we only pay 3% to a specialized lender instead of having to pay 35% to the IRS, because I'm not getting more representation just because I pay more taxes. Okay, and at that point, you're just widening the gap, and that's how multimillionaires are made. Does that all make sense? Day trades do not make millionaires. It just fuels the system that is passive income, and it's the compounding nature of this passive income that builds it up. Because if you've got $15,000 in this position, you're getting 1 free share every month. If you double that, you get 2 free shares every month. If you get it to the point where you get 234 shares every month for free, guess what happens? The delta increases again, and it goes exponential. So you've got your 234 shares, providing 234 shares, providing 234 shares, providing 234 shares, and it just gets stupid. And then at Spare Exchange, you got a hot mic, by the way. And then at some point, you're filing 13Gs because you have a beneficial ownership in the company and blah, blah, blah. I don't like that. I'll never go up into that territory. I'll always cut my ownership before then. But that's the idea, and it's a long, far out goal, but it is not unachievable. Yeah, how absolute dare. Oh, that's awesome, man. I like Glow. You're looking at building the IWMY up to a weekly payout of $1 to buy $1 of GLO every week. That's good stuff. I like it. Strategic reinvestment. You're putting something that is high yield, high risk into something that is stable, and you're using the high risk nature of that and offsetting your tax burden, and you're using the capital separation of those shares and reinvesting them into stability. I like it. Epic says, now that's 1 share per quarter. That's the goal. Ideally, this is a monthly payout, that specific company. So I've got a good mix. Some of these pay out monthly, some pay quarterly. None of them pay annually that I'm looking at. But yeah, there's a cadence. There's a different frequency, and that's also part of it too. You don't just want to have quarterly payouts in most cases, because you don't want violent jolts in the income to the portfolio. Yeah, some pay monthly, some pay weekly, some pay quarterly. You want to use a good mix, because that helps stabilize the inflow of the account. Because what can happen is you can have your payments cascade at the end of the year, and then that just jacks up your taxes for no reason. Let's say you get all that payment on a weekend, right? Let's say it's New Year's weekend, and you just happen to get paid on the 31st, and it's all your quarterly payments, and they all lined up at the same time. It's very rare, obviously, but then since it's the weekend, you can't offset that, and you just got 25% of your annual dividend income on the very last day of the year that you can't do anything about. It has to be a proper tier system. Yeah, I mean, I like it's the risk hierarchy pyramid, right? I like small positions with high frequency payouts on smaller amounts of money. I like large stable positions to pay out quarterly and to let the smaller positions smooth out that inflow. So the way that I have it structured, I've got Maine, I've got Pfizer, that's quarterly. Maine is monthly. I've got O, which is monthly. I've got, I've got IWMY and TSLY. Those are weekly payouts. I've got, I can't remember what I got. What else do I got? ET, I think that's monthly. And then Schwab ETF is monthly as well, I think. And that's my Pokemon starter pack. You can line up specific quarterly companies that align to pay monthly by rotating. Yeah, absolutely. The XDiv rotation is a very real strategy. But that's more, you have to be a lot more tax cognizant if you do that. And then also you have like wash sale if you have any passive income against those positions. Cognizant just means that you're aware of it. COGNIZANT. Which one? Which word, sir? Dividend one? I'm not sure which word, sorry. I've been using a lot of dividend words. I was answering the tier monthly, quarterly. I'm not really sure, honestly. I'm sorry. This is recorded. You can go back and watch the recording if you want. I can't remember what your word I might have used. I was explaining that I have ET, Tesla, Schwab, O, Maine, IWMY, Pfizer, and that some are weekly, some are monthly, some are quarterly. I was talking about the XDiv rotation. Is that what you're talking about? Okay. That's just a strategy where you buy and sell shares of companies that offer dividends based on when they pay. The XDiv, so ex-dividend, meaning it's a cutoff date where the cash portion of those shares gets removed, the shares get adjusted downward, and then the cash gets paid later. So we also do special dividends, and that is where companies just have bonus payments. Let's say they just get a bunch of cash from a windfall or something. They can offer it back to investors, and we can just trade those as one-offs. And that's another decent strategy as well. But you got to consider for people that owe taxes on that, you're paying short-term capital gains on those instead of holding them for a longer period of time and getting that qualified deduction. Yeah. Yeah. Yep. This is the idea. But I do have to jump off here as well. 2 hours till you buy your EDCLV tickets. I don't know what that is. What's EDCLV? You going to a rave? Electronic Dance Club. Liberation. I don't know. Oh, EDC Las Vegas. Okay, that makes sense. Nice, dude. When is that? Is it summertime? Don't get a heat stroke out there in the desert. You're going to have to stay in those casinos. Oh, okay, cool. So early summer, late spring. Good stuff. I think it's a good time of year. So, all right, let me end the recording. I will upload this to YouTube, and I'll share the link in the channel as well. Does anyone have any questions before I go? You go to EDC Orlando in November this year. Nice. That's a great time to go to Florida. Summertime, ain't it? That's why you can't afford TP. I get it. Or to eat. Well, let's fix that, man. You broke your 100% this month. You clearly have the skill set to get more money. You just have to make sure you have the skill set to follow your skill set at this point. And no one can take that away from you. Once you figure it out, it's a forever skill. So that's what's waiting on the other side. It's more important to take it seriously right now so that you can assess the impact of seeing a number that you set as a target being met. If it means nothing to you and it doesn't influence your decision-making or behaviors, that's great. That's what I like to see. If you find yourself tempted to sustain something or to catch up somehow, even though you just performed really well, then that's worth talking about. That's worth focusing on, because that's what's going to destroy you. Because in the future, that number might be your first million, you know? And then what are you going to do if you have 920K and you take a shot out of nowhere just because you want to try to hit that million and get it out from over your head? Because for some reason, that million means a lot. It's just an arbitrary number. And you potentially sacrifice a six-figure loss. You know, it doesn't feel good. You made me a changed man or a woman, depending on the day. Well, it's almost the weekend. I hear you. All right, I do have to jump off here. I appreciate y'all hanging out. I hope you guys have a great weekend if I don't see you again. I know we're on the free side right now. Let me put the, if anyone is interested in joining Premium, I do have my coaching program in there. You also get access to Lee's coaching and Bull's coaching. The only thing I ask is that if you do sign up for Premium, make sure you use that link or one like it, because I want to make sure that you guys get that 50% discount. So if you click on a Premium link and it doesn't work, make sure you type in the code NEW50 at checkout, NEW50, to make sure that you get that discount. Because if you don't get the discount, I'm going to be mad. Okay? My job is to help you guys get discounts everywhere in life. So that includes Premium. All right. If you do jump in, by the way, we have a wrap-up stream at 3:30 Eastern. We'll see you guys there. If not, I hope everyone has a good extended weekend. Stay safe. Don't eat anything that's not edible, I guess. I don't know. All right. I'll see you guys later. Thank you all very much. Enjoy, and adios.